go in a straight line. It goes like this. It goes up and down and like zigzags all over the place. One of the things that I always talk about with clients is sequence of return risk. Ugh. Right? That sounds like something that some financial guy would go on and on and on about, and I'm going to try to keep it as simple as possible. Really, at the end of the day, what that means is the timing in which you have a return, right? The market doesn't just go in a straight line. It goes like this. It goes up and down and like zigzags all over the place, right? And when that happens, if you were to take the life cycle of, say, $100,000 20 years ago, and you had to follow the market, it would go up and down and up and down. And we all say, well, over time, it will recuperate. That's true. It will. However, the challenge is when? If you're trying to retire at the wrong point in time, when that account is at a low point, you're not going to have as much money for retirement. That's called sequence of return risk. Whereas if you have something that is slow and steady, and I'm not talking like a straight 2%, like a fixed return of interest like you might see on a CD. That's fine, that's good for diversification, but we're not talking about that. What we're talking about is if at the very least we can grow our money with the market, because over time the market will go up, but by never having those dips, only having kind of that little plateau, that little tabletop, and then once the market rebounds and goes back up, we go back up with the market, we're going to have more money. That's just a fact. For instance, when I look at like the Morningstar data, and Morningstar is one of those companies that follows Wall Street, and they basically just report data, like just raw data, right? So it's not influenced or someone's point of view. This is just straight up numbers. When I look at those numbers from the last 22 years to 21 years, if I had $100,000 sitting in the market versus $100,000 sitting in an indexed universal life policy, because that's my favorite tool, I would have more money in 21 out of 22 years. I would have more money in 21 out of 22 years using my indexed universal life policy that grows with the market but does not lose value when the market is down. It just stays the same, doesn't grow, doesn't go down. It just kind of chills out for a year or so if I use that indexed or universal life policy versus the market. Now, I will say, in one of the 22 years, the market's account value would have been higher. So now, why is that relevant? When we talk about our financial advisors, they will always say, well, the market outperforms as a percentage versus the indexed universal life. Yes, it's like 0.25%. It's really not that much. However, when you go to access the money, in 21 out of 22 years, you significantly have more money in the indexed universal life policy. We call that sequence of returns, and the risk that the money won't be there when we want to access it. That's the sequence of return risk. It's all well and good that the market overall outperforms us, but if it's just by a little bit, like 0.25%, and in 21 out of 22 years, you have more money using the indexed universal life policy, wouldn't you just want more money? You would, right? Because when you need the money, you want it to be there. You want to have as much there to access as you need to pay for that trip, to pay for retirement, to pay for that medical expense. So what I would encourage is, if you're not sure where your money is, but you're using an advisor, I would encourage you to book a review with us. We would sit down, meet with you, and we would help you evaluate what might make most sense for you when you're trying to look at what your returns are, when you're looking at the timing of those returns, and help you make the right choices, or at least balance your choices so that you can overall have more money.